Hey, guys. Gotta love the new intro.
I know, it's lovely.
Yeah, we gotta put with TJ Dunham and Chris in there.
I
Well, hey,
like
guys.
the wink at the end.
Welcome to the show. We got Martin here today.
Hello,
Martin,
guys. Can you
hey,
hear me loud?
yeah, we can
Yeah.
hear you. Martin is the CEO of Chain Aware. Martin, you just want to intro yourself?
Okay. So I've been in the sector pretty long. So in January, we launched the first product, actually 2023 in February. It was a 4th of February 2023. And that was an AI-based predictive fraud detector, meaning we predict fraud happening in the future before it happens. And yeah, soon it will be live 3 years. Then we launched as well a rug pull detector. Then we launched many other AI products. So actually, we have launched now in January 12 products, and they are in the fraud detection like a segment. They're in the segment of the growth technologies, like how to accelerate the growth in a Web3, and then as well in the segment now in the portfolio technology. We have as well
Great,
one or two products in the portfolio technology too. So anyhow, we are just
great.
analyzing blockchain data a lot.
So you find frauds in blockchain projects. You find like exploits in the smart contract, right?
Oh, okay. If you're looking at the frauds, okay, there are two types of frauds. So some there's a contracts and there are the wallets now. Very many are focusing on the contracts. Very many. Now there's a lot of auditors. Now this is AI based verifications and all everything. Everyone is very looking on the audit, focusing on the how we validate the contracts. But there's another part of a story. That's the wallets. We focus on the wallets. We focus on the wallet's
Okay.
behavior because wallets, it's your fingerprints, like how you think, how you act, what you do. And these fingerprints, if they're compared with very many other people, are leaving so many possibilities for the conclusions about your future predictive behavior. So that
Yeah.
means we focus wallets only. And for the wallets behavior, then we predict as well what these people do in the future with the contracts. So,
Yeah. Well, we're
yeah.
glad to have you here, Martin. We're going to be kind of, going over our daily news topics, and we love your opinion. Last
Okay.
week we looked at an analysis by Peck Shield, and they showed that November was one of the worst months for total exploits in history, and I can imagine that your tech could be helpful with that, with stopping.
Oh, definitely. Like everyone is speaking of the exploits, but again, like people are focusing on the contracts, or let's leave central exchanges aside. But it's so easy to avoid the exploits because exploits are created by the wallets. You just have to exclude the bad wallets from joining into your DApp. And that's, but people are not doing
Oh,
it.
gotcha.
People are like, hey, anyone can use my contract, and of course, the exploiters will use your contracts.
Where are
So,
you seeing a lot of these exploits? Are they state actors? Are they just big whales that come in and they mess around
oh,
with people's liquidity?
okay, this is now overview. What we are thinking. We are saying all this. It's an industry. It's a scam and a fraud industry, and it's the very highly profitable industry. If you're taking like in a Web3 subsegment, it's not so that some hacker Johnny is waking up on the morning and thinking that he's doing an hack. It's an industry. There is a social engineering part. There is whatever outreach part.
Oh, I
There
know
are
about that
all
firsthand.
all
Yeah.
other parts. So that means we are dealing with an industry. So we are dealing with the industry which is highly profitable, and then we are competing. We are protecting ourselves against this industry with some Stone Age technologies, or not protecting at all. So
Yeah, absolutely. Chris, what do you think?
I was just wondering if you were so able to just predict a normal user or just someone with a wallet. Are they going to dump or are they not? What is their usual trading style? Is it able to look at stuff like that as well, or is it just
no.
specifically for fraud and
Oh, okay, we started from the fraud so that we predict the fraud. And actually, we predict fraud 98%. 98% based on the
Wow.
blockchain history, fraud happening in the future before. So we are predicting before it happens. Now,
Mhm.
then we have also a rug pull detector. Now, our rug pull detector is let me say some numbers. Like if you are taking the Pancake, for example, it's more or less public secret that on Pancake, 96% of pools end up with rug pulls. Now we are predicting 65% of them.
Wow.
Rug pull before
So
the fact. Before the fact.
let's say I was a trader and I used your guys' platform and I saw a token listing on BullX, right, or Neo or one of those with perpetuals. I can use some leverage. And your platform detects that it's a rug. You're telling me I could open up a short on one of those platforms and short the rug before it happens.
This is one way. Oh, there are two ways. Let's say, like, if some trader is creating portfolio, he's putting like 10 tokens because he doesn't know. But statistically, there are so many rugs of them. So he has to already calculate in his profit calculation that there will be so many rugs. Now, if he knows already that, okay, 96% on Pancake, okay, nothing against Pancake, we love it, but 96% of pools created on Pancake are rugs. So now we can predict 65% of them, and we have verification script on our website, so anyone can play it, anyone can check it. So that means you as an investor or your token holder, whatever, mini investor, mini hedge fund, so you can already predict where you put your funds, where you don't put your funds. So you automatically increase your profitability. Now, the other way is shorting, yes. Now, most of these pools are like they're very short-lived. Like there's two hours, 90 minutes, and so. But very many of them they follow the same pattern. There's a huge social engineering. There's a huge noise created in the ecosystems, on the channels. Then people, a lot of newbies, they're coming in, they're buying, and then the rock is so boom. So, but how do we predict it? We say it very simple. Bad wallets create bad pools. Now, good wallets create good pools. Now, if we are looking who is creating the pools, we are looking who is adding the liquidity. And now, based on this information, we predict practically if the liquidity adders are bad boys, if the pool creators or pool creator, or creator, because one moment you're getting the physical, real person, I mean, non-contract, is a bad actor, probably the pool is not so good. That's the logic. That's how we predict. Now, we're not analyzing the contract. We only analyze what happens with the creators and liquidity providers of the contract.
That makes sense.
So just one more, based around that. So could you, because you say it becomes a bit predictable, right? Because they're following the same sort of pattern. Could you then give a rough estimate of when they would rug, what market cap they would rug, or what sort of time frame?
Okay. We have been thinking about this. Yes, it is possible to calculate it. It is possible. We are calculating so many different things, all based on the blockchain data. But we haven't done it. We haven't done it yet because we haven't had like a direct demand on this. What's the time moment of the rug? I know that's then you can kind of write the curve and jump out of the rug in the right time. We haven't done this. So
I think that could be something really valuable because I know like in the trenches you have bubble maps, you have your bundle checkers, and that helps quite a bit. But if you could predict with a certain accuracy, I mean, depending on how valuable the data is, that if you can really predict 99% of the time what projects are going to rug, you should absolutely build an edge out of that. And you just go around and start shorting these projects.
Yeah.
And then market.
They're scamming people at the end of the day. This is giving power to the people in a way, something like that.
Oh, okay, but
if they see you shorting, they're less likely they're going to put their money in, right?
I agree. Just saying that this industry is very fast evolving now. Like I saw how the internet industry emerged. I see as well all the antiviruses when they emerged. Now, let's think antiviruses, the PC before the internet era. The virus creators, they were always 1 or 2 steps ahead. They're like, even if you're creating this kind of systems, there will be already some alternate systems created. They will learn how the algorithm is working. They start to create these fake addresses. They will find fake, good-looking addresses. They start to create contracts from good addresses. They are always 1 or 2 or 3 steps ahead of the good boys. Now, the issue being that the good boys at the moment don't have any protection. They are fully exposed. So that's
Well, that's why you see. I mean, people keep getting away with hacks and scams, and it's 2025, right? I mean,
it is now.
Sight.
Let me add some numbers, okay, and maybe some hard facts now. Like, of course, you probably know the chain analysis. Now, chain analysis, we were in Zug, besides Zurich, we were on one conference panel together with them, and they declared that 0.4% of addresses, like in a Web3, are bad addresses. And we said, no, sorry guys, we think it's more than 10. Actually, it's more than 15. It's like 20%. No.
Are bad.
So, but we are predicting have a bad behavior. So that means the actual amount of frauds, impersonations, bad behaviors, it's so huge in the sector. But now let's think what the chain, nothing against the chain analysis. I love chain analysis, beautiful company. But now let's say what's the side effect of this thing. If chain analysis is saying that there's only 0.4% of bad addresses, then you are fully downgrading the size of a problem. Now, the tops, they're thinking as well as 0.4% are bad. But if the stop and dubs would start to think, no, it's not 0.4% are bad, but it's actually like every fifth one is bad, then you start to take measures. If you're saying 0.4% are bad, you're not taking measures. That's one side. Now, the other side is blocking the addresses has direct monetary impact on you. So we know there are like the hacks and so. And then some platforms, they don't have, any checks. They're just earning on this hacks, money laundries and washing and all of these things. You know the stories. Now, but if you start to block the addresses, meaning you don't get revenues. So.
Well, I think if you block the bad addresses, even if your revenue growth is slower, you're going to be able to grow overall as a project, right? Like, because I see kind of a theme, right? People in crypto, they want to hop onto the next project. They get rugged. But guess what? They had that feeling of euphoria for a second. So they're going to keep doing it. But if it's a team that keeps building and the team is building and it doesn't follow like that classic cycle, people blame the team. And maybe the long-term solution is just keep building as a team, but also eliminate these wallets.
Okay. The solution would be to start to, because all fraud detection for the regular users is free to use. The solution is to start to use these predictive tools. That if you interact with someone, someone is trying to sell to you something, just say, send me a wallet and just sign it that it's your wallet. We call it share my audit. Share your audit. So, and that's how you create a trust, meaning you take your blockchain data, because it's not a fraud problem, it's a trust problem. What do I trust? And how do I create a trust? I create trust by showing my blockchain history. I'm not giving you a new address. I'm not giving you a 3 months old address. If I'm an influencer telling I'm 5 years in the network, I'm giving you my address and I'm sharing my address. So,
what's the difference, Martin? Like, let's say I'm because in the past I've gotten, as a project, someone who runs my own projects, I've gotten an audit in the past, and then what was audited ended up getting hacked anyways, right? Like, what's the difference between a tool like this and what people are already doing with these audits?
Oh, okay. Now let's take on the audits. Now, audits is as well an industry. It's a huge industry. It's like if you, I don't know, they measure it by lines of code, but you easily pay tens of thousands of dollars. Now, what are the audits doing? They're using these automated tools, and many of these tools have as well AI elements, and then they generate this initial output, and then of course what the audits are doing, they have then a human review, but okay, it's so-called Turing completeness. I mean, it's a context sensitive. You cannot simulate all situations because your smart contracts are running in a certain context. It's like this theorem on the computer science, Turing completeness. One program cannot prove that the other program is completing. Meaning, I cannot prove. Now, if we say this in a normal language, meaning I cannot prove. I cannot create 100% proof of a certain achievement in a certain program. It's not possible. It's called Turing completeness. It doesn't work in a programming language. I cannot prove it. with another program. Now, and because of this completeness issue, like of course the auditors are not finding the not finding all the issues now, but even let me trace it a little bit further. So now, and auditors, of course, they want to earn money. They use a lot of tools. Maybe they're not using their most best people. Their best people are then doing the sales and yada yada. Okay, and here we are. And then we get this so-called audit shopping, so that projects are doing audits just to get this CERTIC and other names, so-called audit shopping. So beautiful. Now, but what you need is like a multi-layer defense. Of course, you need a contract audit. But if you are on top, that you are interested, that you users who are coming to you platforms, because you know your contract, okay, you want to exclude the bad users, and we call it transaction monitoring. So, and okay, I worked earlier for Credit Suisse 10 years in Zurich now. And if you take transaction monitoring is a standard practice. It's a regulatory mandatory standard practice in a Web 2, but not in a Web 2. Banks are in the Web 1. If you don't have transaction monitoring, you don't have a bank license. It's withdrawn.
No, so I know. I mean, actually, one of the our companies is incorporated in Switzerland, so I know how you guys operate. And yeah, I mean, we really need. There's a lot of fixes, right? At the contract level, we need fixes in this space. At the exchange level, I think if more people had access to on-chain intelligence, they'd be able to make better decisions, and they wouldn't just be throwing all their money into rugs again and again and again, because it's a big extraction cycle. Like, you look at where we were as a space previously, in 2022, there was like 20,000 tokens. Now there's 20 million tokens. And then 99% of retail is going in and they're getting slaughtered because they're going into pump fund coins. They're going into rug pulls. And they're not going into coins with real intelligence like what you're building.
Yeah, and it's a social engineering. It's not just that you're getting rug pulled. There is a social engineering on Telegram, on Twitter. There's this hype creation, narrative creation. A narrative is created. FOMO is creating, fear of missing out is created. And the result is the environment is created so that if you don't have tools to protect yourself, you will not survive. And this is happening now with the most of retail people, most of new users. Now, what's the impact of this one? Of course, there's there's bad industries extracting the wealth from newcomers, but the side effect is these newcomers are getting burned. And then they will tell their friends, hey, I joined the Web3, I got shocked 5 times, 10 times. The industry is dead for me. Now, how many people are speaking this? So many. So that means you see the impact of all of this is that we're actually scaring people away from Web3. Now, and what you say, the fraud, like we keep the fraud tools free. The rug pull we keep free too. In rug pull we say you have to connect the wallet. So, but in a fraud, even you don't need to connect the wallet to do the fraud checks. So, but
it's widespread, even in like Bitcoin, you see this massive manipulation that's happening every single day. Like here's Bull Theory posting about Bitcoin, how no negative news, no FUD, but then $203 million of longs just wiped out like that. Just pure manipulation. And yeah, I mean, one of the issues with decentralization is we're so decentralized that we can't come together and eradicate this stuff from the space because there's always incentive to do it, right?
Or incentive not to do it. Let's think. Okay, let's take fraud detection, and then let's speak a little bit of this Bitcoin markets happening now. In the fraud detection, there's an AML, and that's what then AML and AML based monitoring. That's what Chainalysis is then saying that 0.4% are the bad addresses, and there is a transaction monitoring based monitoring where we say like, hey, it's 15-20% of bad addresses now. So. Like if you start to use these technologies, you bring down the fraud. But if you start to use these technologies, there are side effects. Dubs will earn less money. There are all these side effects. Now, that means everyone as an individual starts to lose. I mean, as a project starts to lose, because there are still projects who let the bad money just to flow in. But the result is the full ecosystem is losing. So, and you need these two sides. You need AML. Okay, no discussion. Yes, you need AML. Agreed. And you need transaction monitoring. No, actually, both are not used. So now regarding these things, what you showed on this Bitcoin thing, because we have 12 products, 12 predictive products, and one of our products is as well a portfolio analytics. Because we are CFAs too, the chartered financial analyst. So, and what we are saying, if you are in this kind of environment where you see this kind of big bumps, dumps happening, it's not an environment where retail should trade. These are big boys are doing the actions. And so what the retail can do, what retail can protect himself is just to create a portfolio. Create a portfolio, the rebalance.
Diversify.
Not just, there is a definite, there's difference between diversification and the portfolio. Now, if you create a portfolio, it's a return risk optimized. We already considered the correlations. We create a portfolio in this way that these correlations, we try to keep them like independent correlations, or a little bit negative correlations that they go in a different way, but we still get the return. Now, if you're doing directly just diversification, it doesn't mean that we are bringing a portfolio risk down. Now, if you do the portfolio, this advanced algorithms of portfolio creation, we give return and you bring the risk down. So you actually need both. You need the return up and the risk down. And that's what portfolio technologies are creating now. If you do diversification only, you probably are not bringing down the portfolio risk. Okay, you maybe getting the return. So you need return risk optimization. So, and if you see these kind of charts, just do return risk optimization. Just, don't trade.
Well, I mean, risk optimization is a term that's not very understood with us degenerates, right? It's funny, you see that meme in the space of The Intelligent Investor, by Benjamin Graham. People are throwing the book away, and it's like, if we would all just read that book and we would apply these strategies, you would see a lot better results. But the big boys kind of rely on that not happening, right? And that's why you get this happening time and time again. These longs getting liquidated and complete manipulation across the board.
Yes, and this manipulation of the Bitcoin price, it will continue as long as it's profitable. There is an industry behind this, and this industry is profitable. In the same way as there's a fraud and drug pull industry, this industry continues. I mean, this industry will continue a long time because it's highly profitable. It's very profitable.
Yeah.
Now, there are ways to count, and actually Chainaware, because we are two co-founders, we are just saying, hey, let's create these technologies for just to protect this community, because if it continues this way as we have now in a Web3, okay, frauds, drugs, okay, now the price manipulations, and then there's one more topic I haven't mentioned yet, okay, maybe later, meaning it's so hard to generate revenues in the sector. It's so hard to generate revenues.
Unless you do the bad things as well, right?
Unless you do the bad things.
It's like you either die the hero or live long enough to see yourself become the villain.
Bingo.
I've heard that so much over the years.
Yep. So,
well, it's true in this space, right? I mean, if you're a founder like Martin here, or me, and you work hard in this space to create real utility, you don't rug your holders. And then you see everyone else around you, they're rugging and they're just building their careers. They're making millions.
Money. Yeah.
It's like, at the end of the day, though, the real builders, we just got to focus on utility, like that's what Martin's doing here.
And so we spoke these two segments. The one is the fraud rug pull. There's industries there, solutions are there, but everyone has to lose a little bit so that the full ecosystem will win. Then we looked on this Bitcoin chart there, this up and down, flush out the longs, flush out the shorts, flush out the longs, flush out the shorts. You cannot trade there. You cannot trade. But what you can do is you just create a portfolio.
Then CFA, you have a unique for having the CFA charter, you have a unique take on everything, right?
And that we even created, because everyone is speaking AI agents, and so on. We created MCP for the portfolio creation MCP, and okay, there are multiple derivatives of this MCP, but we have one free to use, and it works on CoinGecko categories. So okay, we know CoinGecko categories are not investable, but anyone can go on the website, fully free to use. Sometimes it's down because people are asking too many queries from there. and you see how to create how to mix different categories. Of course, then it's a manual work after that.
Well, I wanted to ask you, Martin, with your unique experience, you mentioned being at Credit Suisse, you mentioned having your CFA. Would you recommend getting your CFA? And can you kind of explain to people what that is? Because I'm a big fan of it. I studied for it, right?
Treasure.
I think it's worth it.
It's definitely worth it. Now, okay. Now I don't want to show off. I have an MBA and a CFA. Now, if you have to choose from both, choose CFA. Now, why CFA? There are the 3 parts. First one is easy. Now, the second one, okay, tough. The third one is going to really investment now. Because if you look like what Credit Suisse is doing, Credit Suisse is private bank. And there is an investment bank. But what happened, the investment bank became too big and created many issues. But technically speaking, Credit Suisse is a private bank. And private bank, it means how you generate wealth with money, how money creates money. Now, you have to look what the rich people are doing. The rich people are not trading. The rich people are not hunting, some
They're protecting
new
their principal.
5x's. No, they are creating portfolios. And all CFA, technically speaking, is about this: how you create portfolio, how you and how you guide it. Now, so how you develop the portfolio.
Let me pause you real quick, Martin. So I know getting the perspective of getting a CFA for a job, that's one thing, but let's say for our trader or people who trade the markets who watch this show, is it worth getting a CFA to manage your own personal portfolio?
Oh, okay. Now, there are, maybe if you're a trader, there are 2 other certifications. There's one is a Kaya. Okay, my co-founder is CFA and Kaya. Okay, I'm on CFA. Now, Kaya is Certified Alternative Investment Analyst. That's a Kaya. Then you're going a little bit more trading. CA. And then you have a special technologies now, special certifications like certified financial trading and so. These are
CFP or something.
CAFT. Also, it was a long time ago. I don't
because I'm curious. You can always get your MBA. You can always get a CFA, but are they just letters at the end of the day for someone who doesn't live in the corporate world? Let's say you manage your own portfolio. Let's say you are somewhat successful in the space. You have 500K or more that you manage. Is it worth it getting a CFA to manage?
Definitely. Because you learn all these things. You learn how you, even if you cannot use it maybe on certain tokens, you learn how you hedge your risks. You learn how you create your portfolios. Let's say, very important part, in private banking, it's standard. No, but in a Web3, I'm not aware of anyone who's doing this. If you create portfolio, the portfolio has to match with your ability to take a risk, a willingness to take a risk. Sorry, willingness to take a risk. Let me make an example. Some people, if they lose 5% overnight, they cannot sleep. Other people, if they lose 50%, like TJD,
sleep like a baby. Hey, I mean, when you lose 50% and then another 50% and another 50%, it doesn't hurt as much the second time.
People say it's it doesn't matter for me. Actually, it matters because people's psychometrics are different. So, and when you create portfolio, you have to create portfolio so that it matches your psychometrics. Or if you are clients, that it matches your clients' psychometrics.
Be careful. I mean, if complete degenerates match the psychometrics, it's not going to work out.
No. It means only that some people don't have issues with taking higher risk, because if you take higher risk, you get higher return long term.
Yeah.
Long term. No, but short term, probably there will be tips. And then your wife is asking, "Where's the money?" or something in this question.
Show me the money.
Situation.
Let
So-
me ask.
The worst one is because you're talking about waking up and it's okay, I've just lost 50%. The worst part is when you're on Solana, say, yeah, and you shouldn't sleep on a coin on Solana, and then you wake up and go, no, and you see your wallet down 98%.
Well, I think if
Mhm.
like if what Martin is saying, if everyone got a CFA, I mean, it changed the industry for sure. I want to
Okay.
ask you. Go ahead,
Please.
Martin.
Oh, okay. I just want to say, like, you see, like, when we are looking at, we created, actually, Chainaware is focused on the blockchain analytics now. And then when it was end of May, beginning of June, we launched this portfolio creation MCP. Like, it's actually a little bit like
I'd
an
love to
outer
check that
source.
out personally.
Like because it's not directly analytics, it's not directly prediction. So, but we were like, hey guys, like the guys, communities, people have to get the mindset. Don't trade. Before Credit Suisse, I worked for the biggest independent hedge fund called Man Investment. Most of people don't know Man Investment. That's fully okay. If you have 5 million or more assets, otherwise you don't know. So it's fully okay. I worked there, biggest independent hedge fund.
Subtle flex, Martin.
So that was 2007, 2008 there. Now, that time we had a technology. Retail today doesn't have it. They don't have it. Now, if you're doing trading, you need a trading strategy, you need a risk management strategy. Now, okay, most of retail doesn't have trading strategy. Okay, maybe let's say 10% has. Do you have a risk management strategy in place?
Yeah.
So, meaning like, okay, we created this portfolio thing. So just to say to people, like, if you are trading, your opponents, the other side, it's a very advanced, with very advanced trading strategies, with very advanced risk management systems. Now, if you're trading, you're just a dinner. They eat you for fun. Now,
Yeah.
and we said, how can retail earn? How can retail accumulate? Very simple. Do the same what rich people do. Create a portfolio, rebalance.
Yeah.
And just look on this, all the KOLs, all these Twitter wars, and so
just don't follow any KOLs. Is that what you're saying?
Exactly.
I think,
mathematics will solve it for you.
The stories that I see where a lot of retail wins is if they treat Bitcoin like a savings account. Is not financial advice. I think Martin's the only one that can give financial advice here because he's a CFA. But if you treat Bitcoin like a savings account and you're not constantly pulling out the chase a meme coin, but you put money in there, just treat it like a high yield savings where you're not constantly messing with it. So it's not, messing with your psyche. Because I mean, there was a guy, I just saw it again on Twitter this morning. He put $30 a day in the Bitcoin. He did this for 7 years and it became $1 million over the 7 years. And his principal investment was only 84,000. That's over a 10x.
Exactly. Like Bitcoin, 60% of MCAP. Now, stable coins are other 10%. So that means Bitcoin and stable coins are 70%. Now, Ether takes away the 10% and PNP 4%. So 84% are stables, Ether, Bitcoin, PNP. So, and now everyone is focusing on the 16%. Now, why focus on 16% is 84%? Focus on the 84%. Now,
it's not as exciting, Martin. That's why. It's not as exciting to chase the safer coins, right? Like Bitcoin and ETH.
Yeah. Okay, it's like a gamification. Like there's this adrenaline, and trading is addictive, and that's bad. So people are trading sometimes to make profit, they get losses, but it is kind of addiction. So now, and when people start a lot on this trading, it's really they are stuck on the screens. They're stuck. How you unstuck yourself on the screens? Very simple. Like Twitter is just entertainment, and create a portfolio. That's it.
Yeah, I think part of it too could be like, if you have real money that you don't play around with, put that on a centralized exchange like Coinbase, or put it on an exchange, or even get a financial advisor if you have real money, so that it's way harder for you to go chase into some meme coin, right? Because 99% of the time, if you want to put your money into a meme coin and you can't for a couple of days, by the time you're ready to put the money in it. It rugged already, and you're like, oh, thank God I didn't do that. So, well, one thing's been eating away at me here, Martin. So you mentioned your experience in the hedge fund world, right? You have your CFA. You're extremely qualified to be developing chain aware. I also want to ask you about prediction markets like Kalshi and Polymarket, because personally studying the market, I think the biggest opportunity for financial firms and hedge funds in the next 10 years is to hedge risks in the prediction market. I wanted to get your opinion on that.
Okay. If you ask questions, I give you unorthodox answers. Now, okay, maybe it goes like a Web3 and like what are the next big things? Okay.
Yeah.
Now, there is in Europe, there is one market. Market size is 130 billion annually. And it's dominated by 5 players. It's an advertisement market. Advertisement. It's advertisement data. So now, let me come to this point. Let me come. Now, what are the issues in a Web3? Okay, we spoke one issue, fraud. One issue, portfolio, and people are losing all the time the money because they are like trading instead of like cooling down, creating portfolio and waiting. And the third issue, that the projects have very difficult to generate revenues now. And this is all directly linked to the ad systems. Now, if you do MBA, I'm saying I did MBA, I said, don't do MBA, do a CFA or do Kaya, because it's much more practical. Or then this computer, CAFT or so, like computer advisor, technical, whatever. Now, okay, sorry, I'm getting a little bit lost.
Advertisement market.
So advertisement. So now, Web 2, Web 1 and Web 2, what was the innovation of Google? It wasn't this what they tell you in the marketing schools. And the Spotify is not the network effect. It was taking down the advertisement costs. Now, if you take down the advertisement costs, everything scales. That's how Web 1 became the Web 2. Now, an advertisement is directly created with prediction. You see, if you're saying prediction market, of course, I can create a prediction market. What will Mr. President Trump do tomorrow? I can create this prediction market. But this is like a gamified, it's the same pump.fun now, a new incarnation of the pump.fun.
Okay.
But because it's again like a trading, gambling, adrenaline,
Mentioned markets.
Yeah, but I think the biggest opportunity, if you want Web3 to succeed, is the same that Google did. I know some people don't like Google. I say it's their genius. It's the genius is that they created, that they started to predict user behavior. It's a user behavior prediction. And based on user behavior prediction, they created a targeting systems. And this targeting system took the costs of user acquisition down like 20x or more. Because if you target right people, you increase your user acquisition. Now, so that means if you speak of the prediction market, so the one thing is this prediction market, as we know, the Polo market, but the other is then all the wallets. It's a gold mine. It's a gold mine data. Maybe some people know, like Facebook took over the WhatsApp. I think they paid $19 billion.
That's quite a bit.
For the WhatsApp. So it was like, I don't know, 10 or 15 years ago, everyone was surprised. Why it's so much? Why it's so much? Why are they paying so much? But
it's the data.
The difference being, Facebook, I can pretend to be anyone. In the WhatsApp, it's my phone calls. It's with real people. Okay, no AI bots that time. I can calculate who you are based on this, with whom you speak, how long you speak, when you speak. So, and that was the real data. It wasn't the value of the WhatsApp, it was the value of the data. Now, take the blockchain. All data is public. All data is public. The same data that WhatsApp, Facebook paid so much is there. And now, based on this data, you can predict so many things. So, yeah, I know people speak prediction market, but I say prediction data. Okay, and but back to your question. So, what will happen with the prediction markets? I'm afraid it will be like this pump.fun.
You think it'd be a pump fund? Another pump fund?
Yes.
Well, the way I look at it is there's going to be institutions, there's going to be large sports teams, businesses, and they need to hedge their prediction market, right?
Yeah.
Let's say you're a losing sports team. You don't want to be caught betting that you're going to lose, right? So you're going to pay a hedge fund that will capture your losing edge for you so you at least can be profitable while you're losing, right? Or if you're an Apple insider, the team at Apple eventually is going to pick up on this, or other companies. They're not going to want their guys betting individually. They're going to pay a fund to do it. And there's so much edge that can be captured because there's guys out there, they built bots, and before a poly market, or a Kalshi market closes, it's at 99% on the bonding curve. They'll capture 1%, and there's zero risk because that market is already considered complete, and they'll do that thousands of times. And it's like, man, why not apply this to other opportunities in prediction markets? So yeah, I wanted your take on it because I think that could be a valuable space for anyone that wanted to start a fund.
Oh, okay. Yes, prediction markets. Yes. But again, this the example, WhatsApp, Facebook, $19 billion, this takeover, it's the data, and you can calculate so much out of the blockchain data. I mean, the biggest value of the banks is not the revenues, it's the data, transactional data of the users.
Well, I think that's why you're so focused on Chainaware, right? Let me ask you, with your data, are you planning on creating like a private edge as well for a fund potentially, or are you just going to be facing consumers?
Okay. Okay, so we have fraud detection, we have wallet auditor. Now in wallet auditor, we predict user behavior. It's free to use. So you predict who will do what in the future. We have rapport detector. Then we have user analytics. That's for the dApps. So any dApps can integrate free to use. Then we have targeting technology. And then we are now kind of launching, it's like in a beta that we are calculating behavior. Now let's think in this way. We are taking now one token.
Mm-hmm.
Tell me one AI token, like not Chainaware, something.
ARC.
Let's call it the ZZ Top.
ZZ Top.
Now, and what we are analyzing this community. We look, we are calculating, we are practically creating something and we give it away. It's free. It's actually already on the website. It's free to use. So anyone can use it and anyone can analyze any token community. No, we are not analyzing Twitter. Twitter, you can manipulate as much as you want. We are not analyzing Telegram, manipulate as much as you want. We are not analyzing the holder numbers. So there's so many things that you can manipulate. But what you cannot manipulate, this is a wallet behavior, because this would be very costly and it requires time. This behavior emerges in the time. Now, you cannot just create 100,000 new wallets and say they have this behavior. No, they don't have.
Well, that's exactly what I wanted to ask, Martin. Like, let's say you have a bad actor and let's say your platform becomes extremely popular. I mean, couldn't they just create a bunch of new wallets and use an engine to generate new wallets, and then they just perpetrate everything through a new set of wallets every time?
Agreed. But there's a parameter time. Now, we are doing in wallet auditor, we are ranking every wallet. The better wallet rank, it's a unique number. It's always changing depending what other wallets are doing. We have soon 10 million wallets calculated. Now, but the wallet rank depends on the time. And all this intention calculation, fraud detection, everything depends on the time. Now, if you're doing now a lot of transactions in a very short time, in 1 week, in 1 day, in 1 hour, the time component is not there. It's not human. Like, there's a human behavior and there's a bot behavior.
The number one indicator in the future that will separate legitimate wallets that you want to interact with to wallets that are associated with fraud, scam, and abuse is the age of the wallet, like an aged wallet ratio?
Oh, no. Okay. We have hundreds of attributes on every wallet. Like, let me visualize it this way. Let's take a token. Let's say token A and token B. Now, okay, and now we have one parameter, one chart that everyone can see for free is experience of tokens, if experience of token holders. So
Okay.
you're calculating for every wallet what is its experience. Now, experience depends on protocols used. Experience depends on transactions. Experience depends on time spent.
It's a ratio of all of those things:
All of
time,
this, all of
transactions,
this. And to build
tokens
up your
extracted.
experience, it takes time. Now, then we have parameter willingness to take a risk, because we spoke earlier about portfolio creation. We are calculating this as well based on the blockchain history. So for teachers, it's, we know, very high, but actually not everyone is teaching. Like real teachers, so these are only 10% or even less. So that means we are calculating like willingness to take a risk. We are calculating experience. We are calculating intentions, which wallet will do which things. Now, we are calculating fraud on every fraud probability. That's the probability he will do based on his, I think, his past fraud. Like all this data, hundreds of data points, it flows together. Now, it will be very difficult to fake. It will be very difficult because,
Yeah.
of course, you can say you fake some parameters of this, but on the end, you cannot fake the time. You have a time parameter. So, like if someone wants to do these bad things, will they invest 6 months to build up 100,000 good wallets, which had to do a lot of transactions in this time? Not with the same amounts, but with the different amounts. So,
That's
yeah.
I really like the approach, right? Because most of these, I've looked at so many of these analysis platforms over the year. I mean, I built one that it did analysis right before you swapped into the token. And I haven't seen this approach before, where you look at the age of the wallets, you look at the time the wallet's been interacting, the types of interactions that it's had with previous tokens, right? And how all of these things, I mean, plus 50 more indicators, how they come together in a ratio. A lot of the time it's just, did this wallet receive money from here, which received it from there? And it doesn't really solve the problem at the end of the day.
Exactly. It's misguiding you. You look only at the money flow, but I don't care about money flow. I care about predictive behavior. I care about who is this wallet. Actually, who is the person behind this wallet? That's what I care about. Because then I know, can I trust the person? Do I want to do business with him? Don't I want to do business with him? Do I want to offer him some products? Don't I want to offer some products? I know what to do. And your wallet is your business card. Now, if you hide your wallet, you don't have a business card. It's like my motto. So, and okay, we spoke of prediction markets. Yes, there can be prediction markets, but I think this data that we can calculate based on the blockchain
The
history, and
data
there's
is
so
worth
much of this,
so much more. Yeah.
is
Agreed.
huge.
Agreed.
So just predicting user behaviors and doing good with this, not doing bad with this, but doing good. Like like we call it the token audit. You see, like who are the token holders? Let me make an example. Just like you take the InfoFi, they're pushing up some project. You see like a full Twitter flood of now, and now you think, okay, like now you think like this is now something that's their token. Like everyone is pushing this token. Okay, then just use token analytics. Look inside. Look who are the holders.
Yeah.
And you probably realize it's just a Twitter thing, coming and going.
Well, how do you, I want to ask, and I agree with you on these things, but a lot of your users are on Twitter. Like, how do you see yourself, getting out to mass adoption? Like, for example, this show, for example, could help. You can always take clips and we can market that. But like long term, how are you going to get into the hands of individuals?
Okay, so like we say fraud. Everyone should use it. Like it's like on the morning you wake up, you brush your teeth. Now, if you interact with some wallet, not with a contract, with some other wallet, check the fraud of this address. And if you
Well,
interact with some people, ask the
yeah,
addresses. Now,
like,
if you interact with contracts, check the wrappers. If you look on the tokens, check the token. Who are the other token holders? Like, is it
yeah,
maybe just a Twitter thing? Like, it's like the same habit like you brush your teeth in the morning. It's like just look on some data. Everything is there, and we are offering this data for free. Of course, there's some models for businesses, so they can get some extra. But regular users, it's all free. So.
Well, and I almost want to demo it live right now because I could see it blowing up on Twitter if you every morning, for example, you had signals that came in your inbox, like this token listed, it shot up to here, 98% likely to rug. And then you just post, this token's going to rug. And then it rugs. And then everyone will look at you like brilliant. You're an oracle, right?
Let me tell you a funny story where we got the idea of a rug pull detector. Where the idea came, because first we had a fraud detector. Now, actually, Chainaware has been copied many times. That time our backend was kind of free. You could use it for free. And our website was copied. And the token was launched. This has been done many times. And the token were pumped. And then they were rugged. And then we used our tools and we looked like, hey guys, we can predict all of these things. So, but this, because some guys, they just created rug pulls on Chainaware copies. Then we said, hey, now let's get rug pull. Let's get predictive rug pull detector. But, and what we are doing, I think on the BNB, it's like 1,400 pools created per day. And we are analyzing every pool. We are analyzing when liquidity is added, like contract creation, liquidity adding. It's like 1,400 per day. Of course, on Solana it's more.
Solana, yeah.
but yeah, we have this. We have all this running, continuously 24/7, analyzing every new pool created.
From a trader perspective, like an overlay that would sit on Pump Fund, right? And you're trying to trade. I mean, I could imagine how cool it would be to get really fast signals there where, it picks out the one token maybe out of 1,000 that's unlikely to rug, and then someone can go into that instead of blowing all their money elsewhere.
Oh, okay, we do less on Solana because on Solana Pump Fund, there's so many of them. There's still this computational.
Too much data.
There's too much data. And there's one thing as well. So if someone from Solana Foundation is listening to this, like, there's one thing I don't like on Solana. It's very difficult to get Solana data. Because if you're using SolScan, you get 500 transactions. And then you have more transactions, you have to really wait. It takes you like 20 seconds or half a minute to create to get the transaction data, but we need transaction data. Now, that's my big question. Why is Solana Foundation creating technology where we cannot get access on transaction data? Not like that. What do they want to hide?
Interesting.
And that's why we are like handicapped on Solana analysis too. Because we just get 500 transactions, we wait, we read the next, we wait, we read the next, we wait. Why are they hiding the data? Of course, we know the answer. Like if there would be data so available, like on Etherscan or BNB
Quiet,
scan.
Martin. Don't tell everyone.
Don't give up as well. Like there must be a way around this, right? A faster way to get through the transactions, because it would be very valuable on Solana.
It will be very valuable on Solana. I'm just saying that it's the only chain where we met this kind of stuff, and that it's difficult to get the transaction data from public data with the blockchain reader. So it's the only chain. So, but on all other chains, no problems. So it's just Solana.
I was going to say, would there be limitations a little bit because people want that data fast? But as you say, it's just Solana where you would have the issue. So it might put people off. That's what I'm trying to get at. Like, you're seeing something that could potentially go to the millions. You've seen it low cap. You want to get into that. You don't want to be messing around with something that's going to cost you that time. It might save you money. But a lot of degenerates don't see that, do they? They just want to think, oh, no, it'll be fine. I'll just go into another one.
Yes. Oh, okay. We support 8 chains. So I think we have 80% of the market transaction coverage. So, but yeah, Solana, we have this, we are handicapped. This famous 500 issue. Okay, we have raised this, but Nothing has changed.
Well, there you go. We'll just everyone boycott Solana.
No, will not happen. Will not happen.
No,
Sure.
it won't. It won't. But yeah, you know, like you say, there's not a lot you can do. I'm sure you've tried to look for ways around it, but you just focus where you can. You know, it's good that you offer your services for free, and then I'm guessing the higher end of the subscription would be for a business where they'd get the most for their money, right?
Exactly. No, for the businesses, okay, for regular and we have a lot of regular users. Oh, like say we have this portfolio chat where you create the portfolios based on a CoinGecko. Now sometimes it's down because there are so many queries on this. People are learning. DJs are learning. You know, don't just diversify, create, return, risk, optimized portfolio. But Rappel detector, fraud detector, wallet auditor, all free to use. Highly popular. People are using it, and I love it. And then, of course, we have for the businesses, we have this transaction monitoring. But then we have this slight issue, like with some clients, you know, if they use all transaction monitoring, they can do less transactions. They will lose revenues. But we are saying like, hey, they want to, you know, fight the fraud or they want to get revenues, like what they want. And that's an issue that we predict too many things. So compared with the chain analysis and with some other competitors of chain analysis, then we have targeting engines, you know, that we predict user behavior, like a wallet behavior. And based on wallet behavior, practically you know which messaging you give to the wallets. It's the same like Google AdWords, but now with the Web3. So we have this technology. This is used by DeFi platforms, of course, but many don't want that. They don't want that it's so exposed that they're using this technology, because somehow some people are saying that the blockchain data should be private, and so I'm like, I have fully opposite view. I'm saying blockchain data is not private. Blockchain data is your business card. Based on your blockchain data, you are showing to others who you are, and the other businesses, private persons, companies, they can know as well what do they offer to you. So based on your blockchain data. So there's a little bit this, how we call it, discussion on these are growth agents. Yeah, and these are these are the main transaction monitoring and growth technology that we offer to businesses then based on all the data that we calculate. So yeah, and we are getting now soon to 10 million addresses calculated. Plus we have then portfolio technology as well. Okay, there is one project they are doing something for Solana. There is one project with our technology. They are doing something for memes with our technology. So yeah, but the idea is people have to start to use it, like portfolio technologies, fraud technologies. Everything is there. Like and I see like Twitter is like all the time like full of like complaining. And I'm like, hey guys, instead of complaining, take the free tools. Use the free tools. Share what you found. I mean, like that's simplified view. Okay.
Are you implying that that us degenerates should make better choices?
Sorry, say again.
I said, are you implying that us degenerates should make better choices, Martin?
Like, how do you mean better choices? I know I understand the question.
I love
Web3 community. I love it. I'm just saying, if the Web3 community wants to grow, really to grow, you cannot play naked. Like when all your opponents, adversaries, have like industries, be what we spoke before, be it like a fraud industry or be this famous industry which does the Bitcoins ups and down. You need tools. You are DGen. Perfect. You know, there are teachers who just, worked on the field, but there were teachers who started to use like a combines, like diesel engines, like they're producing big farmers. So
they'll start using it like they do with Dex Screener. You know, every degen wakes up, they go straight to their many Dex Screeners that are open, right? I know I do.
Exactly, like a text screen. But text screen is again, it's like a price. They check the price, and so price you can manipulate very easily. I mean, we don't need to speak about this. Like there is so many data what you can manipulate, but there is something that is very difficult to manipulate. This is your behavioral attributes, who you are, because these things are not changing. Now, like some people are saying, oh, you calculate this wallet 3 months ago. Now it's new wallet. I'm saying different wallet. I'm saying, no. People's behavior is not changing. They're constant, more or less constant.
Yeah.
They're getting more experience. Maybe they start to get more, they start to take more risk, but behavior is constant. So, okay, sorry, back to you.
So it's fine. One thing I was interested to ask you though is obviously you have a big team, right? Just how big is it?
Oh, we have 8 developers, and okay, and they've been long time with us. The motto is fast in and fast out. They're really long, and I think that's the basis. So, and myself, I have as well quite some development background, and so we are we are using very much this knowledge that we have, and then we just look how we use on-chain data to create value.
So you're literally just an army of devs.
Oh, okay. We have devs. Then we have a little bit marketing. We have a very strong Twitter. We have very strong LinkedIn. So we focus on Twitter. We focus on LinkedIn.
Well, I was about to say, Martin, especially with you guys being based out of Zurich, one of our board members is based out of Zurich as well. So we should get together, and we might be traveling Switzerland this January. So let's get together.
Very good. Very good.
Absolutely.
Yes.
Well, guys, thank you for tuning in today. This is Martin from Chainaware. He has vast experience at Credit Suisse and also being a CFA and just building some tech that I think is going to safeguard tens of thousands of people in this space. Check out Chainaware. Thanks for tuning in, guys. This is a serious problem that's impacted so many people in the space, not having access to quality tools that are going to show you how to avoid rug pulls. So make sure you listen to the recording, share with your friends, guys. And that was the show today. Thanks, everybody.
Thank you.
Thanks for joining. See you tomorrow.